Today I'm going to limit the people I'm going to feature to Jim Rogers, David McAlvaney, and Stephanie Pomboy. There's three, but I'm going to do quite a bit with David McAlvaney, and then more and some with Jim Rogers, and a lesser amount with Stephanie Pomboy, looking at the short-term view, the immediate view of the economy and the market, more the intermediate view and the longer-term view. I chose to not include the talking heads, Wall Street talking heads who just say the market's going to go up, the market's going to go up, we're in a pullback, don't worry about it. I had some clips like that. I got rid of them. There's like, you don't need to hear that. It's just chatter, blah, blah, blah. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 22nd, 2023. So I'm going to begin with Jim Rogers. Now, if you're familiar with the world of investing, you know Jim Rogers. He's 80 years old. He's been around for almost 60 years on Wall Street. Well, not on Wall Street, but he was initially on Wall Street, but had an illustrious career, co-founded the Quantum Fund, and made investors billions and billions of dollars. The Quantum Fund shorted the British pound sterling and nearly broke the Bank of England and delivered to their investors a return of 4,200%. I think the same period of time, the S&P 500 was up 4%. So he is and then at age 37, following that, he retired. He just cashed in and said, I've got enough money. And then since age 37 to age 80, he has been investing his own money, but he has called it right in a number of cases. He called the 2000 tech bubble crash correctly and shorted the market, and in particular the tech stocks. And then in 2007, he called the housing market, the crash of the financial stocks, and the real estate market correctly, and shorted those. So he's very careful when he shorts, doesn't do it very often, but he has a knack, I think. I don't know what his technical indicators are, but he also seems to have a knack for calling things correctly. Not precisely, and he always says, I'm a horrible trader, meaning he usually gets it right, but he's usually early. So his insights are good. He would very, very quick to say, don't rely on my comments for trading advice. But I love to listen to him. He's entertaining. So I'm going to play a clip from him that's where he's being interviewed, and he just gives his insights. I mean, here's what I think is going to happen. Here's where we are. But he's very careful, and I try to do the same thing. He's very careful to not predict and say this is going to happen. He does say we go through cycles, and the market is going to crash. I'm not going to tell you when because I don't know when. So things like that. But I think you'll enjoy this piece from Jim Rogers, built on decades and decades of successful investing. Take a listen.
Well, you're correct. Speaking of the U.S. market, the U.S. market's never had such a long up period, 14 years now. So historically, we must be coming to the end, but that doesn't mean it has to ever end. Maybe it'll go on another 14 years. In my view, there are signs that we're coming towards the end. I'm not selling short yet, but I can see, we have a lot of new people coming into the market. They call their friends and they say, I've discovered this new thing called the stock market, and you can make money. And it's easy. It's easy to make money. And everybody's very excited. Some stocks go up every day. I've seen all of this before. These are signs that we're getting towards the end. It's not the end yet, but we're getting there.
Well, but you say it's sort of laughingly that it's easy, but it's just been easy to make money. So you just literally had to buy the most obvious things. Like you had to buy NVIDIA, you had to buy Tesla, you had to buy Apple, the most obvious things that you see around you. You buy them, you make money. And then you have me, who I was got more serious about the stock market, I think in 2018. And, I tried, I threw everything at it and the kitchen sink. And I was, I'm still learning about geology, trying to play explorers, going into the miners, averaging up in everything that I should not have been averaging up. And it was not easy. And so I haven't made money. But for most people, it was easy to make money.
Well, Antonio, that's wonderful. That's great news. Never been easy for me. Now I know the easy way. I just have to call up and buy Apple, and I can be rich.
Well, that's been the case. That's been the case so far. I don't think it's wonderful news. And if you think it's wonderful news, I'll call my wife and I'll let you tell her that it's wonderful news, because she's not super happy about it.
Well, as I say, many people read the newspapers or see the TV or whatever, the internet, and say, I could have bought Apple, but they didn't. And 1995 or whatever year, 2000, whatever year you want to pick, if it was so easy, everybody would have just bought Apple and everybody would be rich. It doesn't work that way. In 1995, if it was that easy, everybody would have bought Apple, and that would be it. We'd all be rich and there wouldn't be any market anymore.
The next piece is from Stephanie Pomboy. She is an analyst. She's an independent researcher, sells her research to investment firms on Wall Street. So she's insightful. She's got a good track record, and they pay her good money for her research. And she is saying the Fed's rates on the economy, raising rates, has been interesting because as they have raised rates, there are some fundamentals in the economy that are weak, but they have raised rates, the market has continued up, and it kind of makes no sense, but it keeps on going up. When you look at this, and she steps back from it and looks at it, and you can see the contradictions, the imbalances between the market going up, the Fed raising rates on an underlying economy that basically has got a lot of weakness in it. Yes, there are segments that have strength, but there are, the price earnings ratio is still elevated, and the market keeps going up. So anyway, she as an independent researcher, she's issuing a word of caution saying, be careful from here. I think this is correct. So take a listen to Stephanie Pomboy.
So you got a remote perch, which you can see the world, which gives you a non-consensus view. So we're going to start super broad. What's the world look like to you today? What's going on out there in this summer of 2023?
Well, I think this is kind of a fun time to do this podcast, because we've had this year basically where the Fed has raised rates in unprecedented fashion on an economy that's toting record amount of debt. And initially the markets realized, hey, this probably isn't going to be really a lot of fun for us. Let's see how this plays out. And have now concluded that basically those rate hikes were a giant yawn, and that the economy is not going to have a recession. And basically the second quarter was the low for profits, and we're going to claw our way back to double-digit profit growth next year. And the Fed will pivot, and you're a schmuck if you're not getting along, with everything you got. My sort of self-appointed job, I view as being to identify what's priced into the market and then pick at where that might be wrong, where the opportunities lie around where the consensus might be wrong on that. And so when I see everyone who used to be forecasting a recession and just trying to figure out when it was going to happen, taking it off the table and saying, okay, the worst is over, it's all going to be good, I have a fair amount of skepticism about that, and we can go into detail on it. But basically, it just seems to me like basic math at the end of the day. If you take interest rates and you raise them, in record speed and magnitude on an economy that has twice as much debt as it did in 2007-8, and a corporate sector that has twice as much debt as it did then, you're probably not going to have a better outcome than you had then.
And then finally, I want to play a piece from David McAlvaney. He and Kevin Orrick are doing a back and forth interview commentary. And if you don't subscribe to the McAlvaney Weekly Commentary, I do recommend it. It's about an hour long. It's each week. It's a podcast, and but it's full of insight. So I'm going to play, and I've played these before, but I'm going to play 3 separate clips that from this past week's commentary that I thought were insightful. He usually has a macro view and a world view. Anyway, with that in mind, the first piece is only 30 seconds, but basically he's saying that stocks are at historically high levels, their highest level in history, based on Tobin's Q ratio. And he goes into that. So when you look historically at this, it definitely gives you pause to say, where are we? I'm actually going to show you following this, I'm going to show you a chart that he does on the podcast. It's actually on his website. It's from Tobin's Q ratio, which will illustrate what he's saying. So take a listen to this.
Going back to Easterling and Andrew Smithers, either of these gentlemen could have penned the article in the most recent edition of The Economist. The piece titled, "American Stocks Are at Their Most Expensive in Decades. Are They Worth the Cost?" They're looking at a different measure, equity risk premium. And on that measure, too, you could conclude that this is the time to be cautious.
The next segment that he does is he makes the case for tactical investing. Now, I don't know how he does it exactly, but he's basically saying there's a time to invest and there is a time not to invest. So to speak, pulling your money off the table or a portion of your money off the table. That is what we do. I don't know what method he uses. We obviously use something different, but we do the same thing. And I believe the same thing. There is a time to invest. There is a time where the markets are undervalued enough where it makes sense to invest. Appropriately valued or undervalued. There's also a time when stocks, equities are highly valued, meaning there is not much upside left, if any, and there is quite a bit of downside. And that's where we are today. There is quite a bit of downside left, and there is not much upside. Stocks are at approximately a 20 to 1 PE ratio, and that's expensive. So, and this today, actually, the day of this recording, we are exiting the market. Our indicators are telling us to get out. We are getting out, and we will put client funds in money market funds. So until we get an indication to go back in. But right now, it's gotten to the point where it's too risky. And so that's our approach. But take a listen. He makes the case for taking a look at valuations and as a result, taking some kind of action. And the reason this is significant is because the traditional approach, the traditional financial advisors do not say that. They always believe and promote the idea that the market's going to go up, and they ignore when it goes down. And clients, as a result, investors, take losses. They go down 10%, 20, 30, 40, sometimes even 50% or more. We've seen that. And they always say, just keep your money invested, the market's going to go up. The tune is always the same. And so this pullback, how far down is it going to go? Nobody really knows. I don't think it's going to go down a lot, but I think it's going to go down. So that's what our indicators are saying. We will know in retrospect, in hindsight, we will look back and say, oh, there was this kind of loss and we got out on this day, etc., but we don't really know. So take a listen to this.
Why now would you be interested in taking more risk without more compensation for that risk? So the conclusion is very much in line with what you'd surmise if you were looking at Tobin's Q.
which was Smithers.
Yeah, originally Tobin himself, but certainly Smithers pointed to this measure where you're looking at the value of equities, their replacement value, and you can get these numbers from the Fed's Z1 report, where it gives you an aggregate value of corporate stuff, so to say. And if the stock market is selling at a premium above the stuff, then it's expensive. And it can be on a range from mildly expensive to insanely expensive. And it can also sell at a discount to its replacement value as well. So Smithers says the simplest rule is to hold stocks when Q is below average and to hold cash when it's above. Smithers qualifies that very simple rule by saying that it's not when stocks are expensive, but when they are very expensive, that it makes sense to hold cash.
Which is not a huge percentage of the time.
No, roughly 17% of the time. If you're looking at 100 years, 17 years out of that 100-year stretch, timeframes in which you should be prioritizing cash and maybe considering how extended you want to be into the equity markets.
So are we very expensive right now on Tobin's Q?
He defines very expensive as anything above a 50% premium. That qualifies as very expensive. That is by the Q ratio. We reached 61% in the second quarter of 2021. You recall we talked about the everything bubble. Well, stocks were right there amongst the everything bubble. So it's trended lower since then. The most recent calculation based on the Fed Z1 report is a 56% premium.
So very expensive.
Yeah, and a reading of undervaluation is marked not just by giving up the premium over its replacement cost, but quite frequently when the trend going from overvaluation lower, when that trend gets in place, it continues for some time.
And then the final piece is he talks about the traditional 60-40 portfolio and how that is constructed. 60% typically in bonds, 40% typically, stocks, 40% typically in bonds. And the older a person gets, the more those tend to change places, overweighting over into bonds with older people. That is the traditional approach. And for 40 years, that worked until it didn't work. And last year we saw when it really didn't work, when all of a sudden interest rates had started to go back up, which meant the price of bonds and bond funds went down, and but traditional financial advisors, traditional investment models stayed invested, and people paid a price for that. What's interesting is that this year, 2023, equities have gone back up, but bonds have not participated. Bonds have stayed down and have been negative, even further negative this year, putting a drag on 60-40 portfolios and on equities. Then he talks, kind of at the end, he talks about the PhD economist. Now, he's nice about this. I'm going to read between the lines because I've listened to McAlvaney for a long, long time. He kind of makes fun of the PhD economists, that they really don't know what they're talking about. They believe one particular narrative. They're highly educated, sometimes from elite universities, and they just don't see that. They always believe that the market is going to go up, and if it's going to come down, there is a correction, or this is normal, or you stay invested. They always have the same narrative. Traditional financial advisors follow these traditional PhD economists, and they say the same thing. They haven't done the research, the economists have done the research, but the traditional financial advisors buy into that narrative. And and we're coming up on it. The market is going to go down a lot at some point. We don't know when. That's the $64,000 question, when. But it is going to go down. And I think Jim Rogers in his piece talked about this, that the market goes in cycles and it's going to crash. I don't know when, but that's going to happen. We are now 15 years into an up market. 14 years, 15 years. So this is the longest, or one of the longest bull markets in history. And so why? There's a lot of printed money and a lot of borrowed money. And so that money has got to go somewhere. But eventually, the piper has got to get paid. and this is going to come down. And I think the further it goes up, the further down it's going to fall, according to the theory proposed by Hyman Minsky. And this is, so he makes a case for this, and he talks about the batting average. He kind of relates it to baseball, the batting average of these economists. And he names the baseball players who had great averages. The economists don't have 1,000%, they don't have 500%, they don't have the best in baseball, which was Ty Cobb, Babe Ruth, Lou Gehrig, and then more in my era, Ted Williams, Stan Musial, and Hank Aaron. And those, had batting averages in the 300s, from 325 up to about 364, I think Ty Cobb had. No, way worse than that. And then, who has the worst batting average in baseball? You may not know that. I didn't know that. But McAlvaney points it out. A guy by the name of Chris Davis. He played for the Baltimore Orioles. He had the worst batting average in the history of baseball, 168. And in 2018, the Orioles appropriately cut him, okay? Either retired him or sent him down to the minors or something, 168. And, but the economists, the PhD economists, he makes this point, they don't have as good of a batting average by a long shot as Chris Davis. Their batting average is 0%. They always miss. They have always missed. The consensus view of economists, and I would say traditional financial advisors, is they always miss it because they always think the market is going up. And they don't learn from history, they don't look at it, they don't study it, they minimize it, and then people who rely on them for traditional advice, they end up paying the price. And you know this probably if you've been around a while. You were invested with a traditional financial advisor. You know what the internet bubble crash in 2000 was like. You know what the housing market financial crisis was like in 2008. I can tell you the traditional financial advisors bought into the idea that that was not going to happen. And then when it did, they said things like, you can't sell now, it's going to go back up, invest for the long run. I don't care if you're 80 years old, invest for the long run. And people paid a huge price for that. I've talked to so many of them, and they lost a lot of money. And yet the prevailing view, I'm going to say the vast 90% or more, the view is that that's just the way you invest. In my opinion, that's a horrible model. And whenever that happens, whenever it happens, people are going to pay a big price for it. In the intervening period of time, what we're trying to do is stay up with the market and be ready to pivot. Stay ahead of the market at times, be ready to pivot. If we lag the market, be ready to pivot. Because when the key is pivoting at about the right time and getting back into the market at about the right time. That's tactical investing. And I think that makes a lot more sense. But when you listen to the talking heads, I didn't want to bore you and use your valuable time to play them. I had a couple of pieces, and I just thought, I'm not going to waste your time with that. You can call any financial advisor and listen to the same thing. So, but anyway, pretty interesting. Take a listen to what David McAlvaney has to say about this.
So the risk of downside in longer-term bonds remains very high.
And Dave, of course, you've had an interesting background through your life because you were raised in this environment around your dad, but you went into the Wall Street realm. And of course, the Wall Street training is that if you're worried about stocks, you go into bonds. If you're worried about bonds, you go into stocks, but you certainly don't go anywhere else. That's that 60-40 portfolio. But there is a problem because that didn't work a couple of years ago.
Yeah, and the general setup is this. You talk to a financial advisor, he asks your age, you subtract the age from 100, and that gives you the rough split between how much you should have invested in equities versus fixed income. And so, roughly speaking, what we witness is this sort of averaging out of ages and demographics, 60-40 portfolio.
Yeah.
And
60%
that's 60,
stocks, 40% bonds. Right.
Yeah. Or if you're moving towards retirement, you'd flop that
Flip it.
around. Exactly.
Okay. Right.
So in 2022, you had contemporaneous losses in both assets. And that leaves the seasoned investor of yesteryear, of yesterday, in a real quandary. What does safe haven investing look like in this period of market history?
But the question would be, are we going into a recession? Because if you look at the news, we're not.
Well, back to the Wall Street hucksters. You get a view, a strong view from the people who are selling stocks and bonds that there's never been a better time to be buying stocks and bonds, says the salesman of stocks and bonds. And of course, you've got the unaffiliated news networks which support that. They've all but dismissed the possibility of recession. And this is largely based on, if you just count the votes, counting PhD economist votes on how this year ends and 2024 begins. So the consensus has gone well past recession, gone well past soft landing. Consensus is now somewhere between nirvana and Goldilocks, sort of a middle ground. Because even that soft landing recession is being downplayed.
But these PhD economists, okay, these guys that are always telling us whether we're going to have a recession or not, does anybody track the results?
Well, it's interesting because the one thing they seem to lack, I don't doubt the pumping of the dendrites and the general intelligence and how fast their C fibers do fire, but I think they don't have very good memories. Must read is the brief nostalgic write-up in Hard Asset Insights this past weekend. Second week in a row of just knocking the cover off the ball. Morgan, my colleague, will include the link for that in the notes.
That's at McAlvaney.com.
Whether it was recessions in the 70s, the 80s, the 90s, or 2000s, economists have consistently downplayed recessionary outcomes and prepared their sort of curious readers, the ones who are engaged, prepare them for a soft landing as a worst case. And they've done that over and over and over again. Hard Asset Insights covers the batting averages for those professional prognosticators, and turns out they're extraordinary. Extraordinarily poor.
Yeah, right.
They're not batting 1,000, clearly, not 500, not even close to sort of the Ty Cobb, Joe Jackson, Babe Ruth averages of 342 to 366. And my cursory research shows that Chris Davis, this is a tough position to hold, but Chris Davis coming in at .168 was the worst batting average in Major League Baseball history. You know what? He looks great compared to the PhDs who struck out on every major swing at the bat. When it comes to predicting recessions, what's fascinating is they do predict 8 out of the 4 recessions that we have, and they seem to gloss over the ones that actually show up. So there's something about the mindset, and then in addition to the mindset that doesn't allow them to see it, they can't remember when it happens to them either.
And then the final clip I've got from McAlvaney, I'm sorry, I thought there was 3. There's actually 4. So this one, he cites Bill Gross. Now, Bill Gross was he was called the bond king. He was with PIMCO, and, they are big creator of bonds and bond funds. And so there's probably nobody that knows more about bonds than Bill Gross, but he quotes him. And Bill Gross believes, and of course bonds are based on, they go up when interest rates go down and vice versa. He says Bill Gross believes that interest rates are going from here in the low 4s up to about 4.5. And if you're not a bond person, you may say, so what's the big deal? And the point is that if they go from here up to 4.5%, that is significant enough that is going to crash the economy and and probably the market along with it. What is it going to do to housing? Of course, it's going to slow housing down. I don't know to what extent, but I'm more focused right now on the economy and on the market. And Bill Gross says, and David McAlvaney says, if that happens, something is going to break. That reminds me of the comment of Felix Zulauf, who said the same thing. Something is going to break. Why? We have too much debt. Too much debt. And Stephanie Pomboy quoted this, saying that the market is going up and we're double the amount of debt, corporate and government. And I would say McAlvaney is saying the same thing. We've gone in 2008 from around 10 trillion. Today we have about 31, 32 trillion, over triple the amount of debt in the government. Corporate is the same thing, and personal debt is the same thing. So it's when it crashes, debt is what causes people, debt and margin, borrowed money, it's all the same thing. That is going to accelerate the crash and make things worse. I'm just saying we're on borrowed time. This is coming up. This next year, I don't think it's this year, but next year, the year after, at some point, it's going to happen. I don't want to predict that, but I would say, given that we've been about 15 years from the last recession and stock market crash, I'd say we're definitely getting closer. So to investors, word to the wise. And if you get out of the market, I said we just got out today actually, and if you get out of the market, have a methodology to get back in. It is very hard to do, because if you rely on emotions or I think this, I think that, you will probably get it wrong, because at the time you need to get back in the market is not the time your gut tells you to do that. So take a listen to this final piece from McAlvaney.
Well, Bill Gross sees a clear path to 4.5% on the 10-year. Why does that matter? Perhaps he's the past bond king who has ceded the throne. Maybe he does see something. We close the second quarter, the end of June, with the U.S. long bond year-to-date gain of 5%. Since then, we've flipped to a year-to-date loss of 2%. Right? This is just since June 30th. So a 7% swing. What was a gain is now a loss. The 10-year, a slightly shorter duration, has stretched past 4% early this week to 4.2%.
And Gross is saying we're going to see 4.5.
Yeah. If rates continue to move higher, something else will break. That's why it's consequential, because the system of debt that we've built can't afford higher rates. And this isn't just the Silicon Valley Bank episode of 2023. This is Black Monday. This is the tequila crisis. This is the dot-com bubbles encounter with a pin. This is the global financial crisis.
All of those had something to do with interest rates.
Well, think about Powell. Powell's pivot in 2019. He's finally getting tough. He's not just talking tough, but then he has to reverse course very quickly. Why? Interest rates are beginning to break things down. All of those instances were accompanied by rates increasing to a critical level and precipitating a major market disruption. While it may not seem like a big deal for rates to have moved from 3.75 in July, just a few weeks ago, to 4.2% in August, this is an uncomfortable territory for any debt instrument that takes its cues from the 10-year. So now you're talking about, by extension, vulnerabilities in the mortgage-backed securities market. Why does that matter? Well, look, if the mortgage-backed securities market begins to come unhinged, you're talking about the finance mechanisms for housing. We know that a near 7% 30-year fixed-rate mortgage is artificially low because Fannie Mae and Freddie Mac are there to subsidize the cost of long-term borrowing. But if there's trouble in the mortgage-backed securities market, maybe we don't see Fannie and Freddie able to hold rates at an artificially low number, and it gets repriced to higher levels. You tell me what happens to real estate if you've got an 8, 9, 10% 30-year fixed-rate mortgage. There's plenty in our audience who were there, financed their homes at those or higher numbers, and they know that on the other side of that seesaw is the price of their home. Higher rates equals lower home values.
Jay Powell, being the waiter, who's ready for another round of crack? He says to the bulls. And he's a distinguished man. I mean, his resume is gold-plated. He went to Princeton. He's got degrees and accomplishments, and he's a gold-plated resume. But when you go back to Janet Yellen and to Ben Bernanke and Alan Greenspan, and even back to Paul Volcker, all of those had gold-plated resumes. And you think, Ben, who are you to question these? You don't have that kind of resume. But you got to realize the Fed chairman works for his boss. His boss is comprised of, is the Fed, comprised of the big banks. The big banks own the Fed, not figuratively, literally own the Fed. And so the only one that I really admired was Paul Volcker. He had the guts to do the right thing, the hard thing. I think Powell has been trying to do that to some extent. Bernanke and Greenspan and Yellen were jokes. Jay Powell is trying to push interest rates down to 2% and really truly quiet the economy. I admire him for trying to do that. He's been compared at times to Paul Volcker. Volcker did it with resolve of steel, and he accomplished it. But it came at a price. The market went down 50% and the economy tanked. But he put the country back on the road to recovery. And during the decade that followed, we added about 25 million jobs and an excellent growth economy, which occurred during the 80s. But you need to realize, with his best of intentions, he does work for the big banks. You may think, well, the Fed is, the chairman is approved by Congress. They have all these great resumes. They're really smart people. True. But they have the interest of the big banks at heart, not you and me. That's just the way it is. I've mentioned this before, but if you've not read this book, it's called The Creature from Jekyll Island, which is a 600-page book on the creation of the Federal Reserve, written by G. Edward Griffin. It is an excellent book. It's a lot of detail to it. I chose to listen to it. But you realize that they're not exactly crooked. I mean, their intentions are literally to just benefit the big banks. And it's not just us. It's England, Europe, Japan, all the countries, really, most countries, have central banks. And they're all created in some fashion to represent the interest of those big banks, not the consumer. So we are kind of at the whim of the Federal Reserve and their chairman. So anyway, I just thought this was interesting that I don't know how good his intentions are. I think they're probably pretty good, but you can tell his goal is to try to balance that, satisfying the bulls and the bears, and convince you and me that he's doing it for the best interest of our country. Thank you for watching, and if you have questions or comments, leave them in the comment section below.